Welcome to the fourth episode of our Foundation series. Today, we are moving beyond the abstract concepts of the market to focus on the tangible tools you will actually use to build your wealth. We are going to explore the full spectrum of financial products, covering stocks, bonds, exchange-traded funds, options, futures, and contracts for difference. My goal today is to help you navigate this toolkit so that you can match the right instrument to your specific goals, your risk tolerance, and your timeline. It is not enough to simply know that these products exist. You need to understand which ones fit your hand before you ever place a trade. Let's get started. The financial world offers a true paradox of choice. Right now, there are over 12,000 registered mutual funds, more than 3,000 exchange-traded funds, and hundreds of thousands of individual securities available to you. Having access to every tool in the shed is actually a liability if you do not know which one to reach for. In this episode, we are going to map these 6 essential product categories to their ideal use cases. By the end of this session, you will understand the risk profile and time horizon for each, ensuring that you choose an instrument that actually aligns with your personal investment strategy rather than just picking one at random. To see why your product choice matters, look at what happened between February 19th and March 23rd, 2020. During that period, the S&P 500 dropped 34% in just 33 trading days. Investors who held broad market funds like SPY recovered to new highs by August. However, those holding leveraged instruments, such as UPRO, suffered permanent decay from their daily reset mechanics and lagged far behind. Meanwhile, Treasury bondholders actually posted positive returns during that exact same market crash. This demonstrates that the same market event can lead to 3 radically different outcomes depending on the product you hold. Choosing the right tool is just as important as choosing the right market. Let's begin with stocks, which represent pure ownership. When you buy a share, you own a fractional claim on a real business. For instance, if you buy 1 share of Berkshire Hathaway Class A, you own a slice of a conglomerate worth over $1 trillion. Keep in mind, however, that as of mid-2026, a single share of that stock costs roughly $740,000. Note that this specific stock has never paid a dividend, as Warren Buffett reinvests all profits back into the company. Stocks offer unlimited upside and unlimited downside. They grant you voting rights, and they sit at the very bottom of the priority list during bankruptcy. They are the foundation of most portfolios, but they require a high tolerance for volatility. Next, we have bonds, where you essentially act as the bank. When you buy a bond, you are lending your money to a government or a corporation in exchange for periodic interest payments and the return of your principal at maturity. U.S. Treasury bonds are backed by the full faith and credit of the federal government. Throughout 2024, the 10-year Treasury yield fluctuated between roughly 3.6 and 4.7%. Corporate bonds typically pay more, but they carry credit risk. Even a company like Apple, which sits on tens of billions in cash, issued bonds in 2021 to take advantage of low borrowing rates. Municipal bonds are generally exempt from federal income tax, though specific private activity bonds can sometimes trigger the alternative minimum tax. Exchange-traded funds, or ETFs, provide the benefit of instant diversification. They bundle hundreds or thousands of securities into a single ticker that you can buy just like a stock. Take SPY, which tracks the S&P 500. It holds roughly 500 large-cap companies and trades over 50 million shares daily with assets near $789 billion. Then there is VTI, the Vanguard Total Stock Market ETF, which holds over 3,400 securities and commands over $2 trillion in assets, making it one of the largest funds on Earth. You also have QQQ, which tracks the NASDAQ 100 and tilts heavily toward technology. ETFs offer you liquidity, transparency, and broad market exposure with a single click. Options are instruments of precision, not buy-and-hold vehicles. An option is a contract that gives you the right, but not the obligation, to buy or sell an asset at a predetermined price before an expiration date. A standard equity option contract controls 100 shares. For example, if you buy an Apple call option with a $200 strike price for $5 per share, your total cost is $500. This gives you exposure to 100 shares worth roughly $20,000. That is powerful leverage. But there is a catch. If the price does not move in your favor, The option expires worthless, and time decay erodes your investment value every single day you hold it. Futures represent binding commitments rather than optional ones. A futures contract is a legal agreement to buy or sell an asset at a future date for a price agreed upon today. The CME E-mini S&P 500 futures contract has a notional value of 50 times the index, which is roughly $275,000 when the S&P 500 trades at 5,500. Yet, it only requires about $5,000 in overnight initial margin. In May 2019, the exchange launched Micro E-mini futures, which are one-tenth the size, making them accessible to smaller accounts. These instruments trade nearly 24 hours a day and are primarily used for professional hedging, speculation, and institutional portfolio management. Now, we must address contracts for difference, or CFDs. These are over-the-counter derivative agreements where you bet on price movements without ever owning the underlying asset, meaning your broker is your direct counterparty. Here's the critical point. CFDs are strictly prohibited for U.S. retail investors under regulations from the Dodd-Frank Act of 2010. While they are legal in the UK, Australia, and Europe, they are not available here. Some offshore brokers may try to solicit U.S. clients via a virtual private network, but doing so puts you at extreme risk of account freezing and total loss of funds without any regulatory protection. If you're a U.S. resident, you cannot legally trade CFDs with a regulated provider. Think of risk as a ladder. At the bottom, you have Treasury bonds, which are the safest because the U.S. government has never defaulted. Next, you have investment-grade corporate bonds, which add credit risk. Broad market ETFs sit in the middle, introducing equity volatility while diluting the risk of holding any single company. Individual stocks are higher on the ladder because they concentrate all your risk into one firm. Options buying is higher still due to time decay and the risk of a total loss of your premium. Futures add leverage that can exceed 10 to 1 and trigger margin calls. Finally, CFDs, where they are legal, combine extreme leverage with counterparty risk. The higher you climb, the more skill and capital you need. History provides us with a clear view of how these products perform over the long term. According to data from NYU Stern, between 1928 and 2023, U.S. large-cap stocks delivered average annual returns of roughly 10%. Long-term government bonds returned around 5%, while Treasury bills returned under 4%. Over that same period, inflation averaged about 3%. These are not guarantees, but they are observations across nearly a century of market history, including the Great Depression and the 2008 financial crisis. The gap between stock and bond returns is known as the equity risk premium, which exists specifically to compensate investors for enduring significantly greater volatility. Let's build a profile for the conservative investor. Their top priority is capital preservation and income generation. Suitable products include Treasury bonds, investment-grade corporate bonds, municipal bonds for tax-advantaged income, and dividend-focused equity funds. Conversely, they should avoid futures, options speculation, and individual growth stocks. Consider a 60-year-old planning to retire in 5 years. They might allocate 40% to short-term treasuries, 30% to corporate bonds, 20% to dividend-focused ETFs, and 10% to cash. The goal here is not to chase maximum returns, but to ensure they can sleep soundly through any market downturn. Next is the moderate investor, whose priority is balanced growth with managed downside. These investors typically use a mix of broad market ETFs like VTI or SPY, balanced mutual funds, and a strategic allocation between stocks and bonds. For decades, the classic 60-40 portfolio, 60% in equities and 40% in bonds, has been the standard benchmark for this group. A moderate investor might hold VTI for total market exposure, add a bond fund for stability, and rebalance their holdings once a year. This profile is willing to accept some short-term market volatility in exchange for long-term growth, but they intentionally avoid concentrated bets and leveraged instruments. The growth-oriented investor focuses on one goal: maximizing long-term capital appreciation. They are comfortable holding individual growth stocks, such as NVIDIA, which powers artificial intelligence, or Tesla, which disrupted the auto industry. They might also use thematic ETFs that target sectors like clean energy, semiconductors, or biotechnology. The trade-off is high concentration risk, as a single stock can easily fall 50% or more on a bad earnings report. Growth investors must have the mental discipline to endure drawdowns of 30 to 50% without panic selling, because they understand that this volatility is simply the price of admission for above-average returns. Finally, we have the active trader, who tries to exploit short-term price movements for income. This is the smallest and most difficult category. Research by Barber and Odean found that active retail traders underperformed the market by 6.5 percentage points annually. A study in Taiwan found that fewer than 1% of day traders generated consistent positive returns after fees. Similarly, research on Brazilian equity futures showed that 97% of persistent day traders lost money. While these products are accessible to everyone, the data shows they are appropriate for almost no one. It is a high-skill, high-risk path that most people should avoid in favor of long-term investing. You must be aware of the cost architecture, because costs compound silently over time. While Fidelity and Schwab offer zero-commission stock and ETF trades, other products carry fees. Options contracts usually cost between 50 and 65 cents each. Futures commissions range from $1.25 to $3.50 per contract, plus exchange fees. Expense ratios matter too. SPY charges 0.09%, while VOO charges 0.03%. On a $100,000 investment, that $60 difference adds up. Furthermore, bid-ask spreads can be costly. While liquid ETFs have a spread of a penny, thinly traded corporate bonds can have spreads exceeding 1%. Every dollar spent on costs is a dollar that stops compounding. Tax treatment is another critical factor. Short-term capital gains on assets held 1 year or less are taxed as ordinary income, reaching up to 37% federally. Long-term gains on assets held over a year enjoy preferential rates of 0, 15, or 20%. For 2026, the 0% bracket covers income up to $49,450 for singles and $98,900 for married couples. Futures receive special Section 1256 treatment. 60% of gains are taxed at long-term rates and 40% at short-term rates, resulting in a blended maximum of 26.8%. Municipal bonds are generally tax-exempt, whereas standard bond interest is taxed as ordinary income. Liquidity is not just a theoretical concept. It determines whether you can exit your position when you need to. SPY trades over 50 million shares daily with a 1-cent spread, allowing you to exit a multi-million-dollar position in seconds. Apple stock is similarly liquid, trading roughly $10 billion in value per day. However, a typical corporate bond might only change hands a few times a day, and selling a large position could move the price against you. Small-cap stocks often have spreads exceeding 1%. Futures markets are among the most liquid on Earth, with the E-mini S&P 500 regularly exceeding 2 million contracts daily. Always ensure your exit price will match your expectation during volatile markets. Leverage is a double-edged sword. Regulation T allows 2-to-1 leverage for overnight stock positions, meaning $50,000 lets you control $100,000 in stock. Options can offer 5 to 10-to-1 leverage, and futures can provide implicit leverage of 10 to 20-to-1. Consider the arithmetic. A 10% adverse move against a futures position with 20-to-1 leverage results in a 200% loss of your initial margin. Leverage never changes the probability of being right. It only magnifies the consequences of being wrong. It is a tool that can destroy a portfolio just as quickly as it can build one if you're not careful. You should use your intended holding period as a filter to eliminate unsuitable products. If you're trading for under 1 day, you are looking at futures scalping, which requires full-time attention. For holding periods of 1 day to 1 year, you might use individual stocks or short-term options. For 1 to 10 years, core ETF holdings and balanced portfolios are ideal. If your horizon is over 10 years, you should stick to broad market index funds and tax-efficient strategies. The longer your horizon, the simpler your product selection should be. A 25-year-old saving for retirement in 30 years does not need futures. They need consistent contributions to a low-cost, total market ETF. Let's summarize 5 common mistakes beginners make. First, trading futures with insufficient capital, where a single contract can swing $2,000 in one session. Second, holding leveraged ETFs like TQQQ or UPRO for months, which leads to mathematical decay that erodes your value in sideways markets. Third, ignoring bid-ask spreads on illiquid options, where the cost of the trade outweighs the commission. Fourth, jumping into complex derivatives before understanding the underlying asset. Fifth, paying high expense ratios when cheaper, identical alternatives exist. Every one of these mistakes has the same root cause: trading a product without fully understanding how it behaves under stress. To synthesize this, you should use the Product Person Horizon framework. Before buying anything, answer 3 questions. First, what is my risk tolerance? Can I sleep if this drops 20% overnight? Second, what is my skill level? Do I truly understand the mechanics, costs, and taxes of this instrument? Third, what is my time horizon? Will I hold this for decades, months, or hours? No single instrument is universally best. A treasury bond is perfect for safety but wrong for growth. A futures contract is essential for a hedge fund, but catastrophic for a beginner. The best product is the one you understand well enough to hold through a full market cycle. That concludes our overview of financial products. In our next episode, we will focus entirely on ETFs, which are the most essential tool in your kit. We will dive deep into their construction, expense ratios, replication methods, and the various smart beta variants available to you today. Most successful long-term investors build their entire core portfolio around a handful of well-chosen exchange-traded funds. And in the next session, we are going to show you exactly how to select the right ones for your strategy. I will see you in the next episode.